presentation that I'm going to share. It's a web link which I am using for now to present the class. So let me share my screen. Okay, by the way, this presentation is being made uh, using AI tools. It's not made by AI, it's made by me, but it's being presented and being designed using AI tools. So you can subscribe, you can use this tool if you want, if you are doing any presentations or want to make any presentations. It's AI enabled. Okay, so now before we begin, why this class? What are we going to do in this class? So I will be sharing with you a feedback, sorry, a framework of how we do the financial analysis, financial statement analysis. What do we do? What kind of inputs that we require? What are the different tools that are available for doing the conceptual, fundamental financial analysis? And then I will also show you some tools which can help you to speed up the financial statements analysis and also make your life a little bit easier. Now, at this moment, the tools are not really optimized for financial statements analysis, but they help in some ways. So we will be exploring them, how we can use them for our analysis. But you may need to understand, you may need to evaluate themselves whether they help you to save your time, whether they help you make more accurate decisions using the tools and conduct the financial statement analysis, or they may not be suitable for your individual needs. So it's a trial and error system that you have to follow. We have a very different class on finance, AI use for finance, where we deep dive into the very basic details of how the AI tools can be used. If you wish, you can subscribe to that class later. But today we are not going to touch base the basic minimum. We are going to start with the foundational principles of financial statements analysis. And then we will go through the AI tools that can help to make it fast, make it better, accurate, and faster. Okay. So that's what the introduction has been there. So the agenda I have, as I have explained, we will discuss with the framework of the financial analysis, the application in different contexts, and then how AI can help. And then we will have a question and answer at the end. I will be breaking down the class in every 1 hour. So there will be two breaks, short breaks, 5 minutes, 8 minutes break to help you get water or loo or whatever you want. If you want in the middle, you can go. So it means that the first break will be somewhere in 1 hour from now, and then another one will be another 1 hour, and then finally we will have a question and answer session. I have shared the presentation link with you. You can download that. You can print it out or put it into PDF and make notes as you go along. If you are not subscribing to the recording session, if you are, that is good. You can refer back to the recording session as you like. Okay, so let's start with the framework for financial analysis. So how we carry out the framework is very basic framework that I have been using. The first part of the framework is to understand the objectives, why we are carrying out this financial analysis. So financial analysis, I will bring out the details of this framework in the coming slides, one by one for each step. But briefly, financial statement analysis can be used for various purposes. It can be used for investment. It can be used for evaluating the company's credibility, liquidity, whether you want to buy from this company or you want to supply to this company. Banks may want to use it for loans. Governments may want to use it to understand their profitability, to compare whether the taxes they are paying is justified. Employees may want to, or potential employees may want to evaluate the company for understanding their operational performance, or whether there is a potential in this company to grow further, right, for their own sake, on career sake. Shareholders may want to look at the financial statements to understand whether they are getting enough returns for their investment or not. Right. So there are different purposes. So the steps and the tools that we use for the state for financial analysis are also different. Depending on the objective. So there is no one size fit all solution that we have here. It depends on the individual requirements of the analytics who is using and what is the purpose of that particular analysis. So we will be covering few scenarios with you so that you can understand and evaluate the difference between how we analyze. The second step is obviously collecting the data, because financial analysis means data, right? So we have to collect a financial and non-financial data from internal or external sources. So there are internal sources, means if we are within the company, then the internal sources could be your profit and loss statement, details, GLs, general ledgers, manual journals, voucher entries, or any other operational reports that you may be getting to support the financial numbers. The external number could be market survey, could be the competitors report, could be the research reports carried out by somebody else. But if you are outside the company, the external internal internal sources would be supposedly your own understanding of the company's financial statements, the information that you possess in your control, and external will be definitely coming from the outside market and those kind of resources which are not in your control, but the data is generated by somebody else. So those are external reports. There are non-financial data as well. Not everything is can be analyzed using the financial data only. There are a lot of things which are not recorded in the financial statements, or there cannot be measured using the financial numbers. So I have a list. You can we will I will show you, or I will tell you what are those things which you have to be careful. Um, the third step is analyzing. This actual analysis. So there are tools that we use like vertical analysis, horizontal, trend analysis, ratios, and there are some other techniques. Then the fourth step, which is usually not carried out by a lot of analysts, is to validate whether the findings are in collaboration with the hypothesis that we made, or carry out the stress test to understand whether the result that we are getting test the time of the questions, because you may be answering the questions on the surface, not deep inside. So maybe you are answering that the revenue is less compared to maybe let's say last year or maybe competitors, but why is that happening? You may be able to answer that question as well, that maybe there's a product sale which is in a particular geography which is down compared to the other competitors, but in that case there is another why is that happening. So you have to also test out the validity of your findings, and whether the insights are sufficient enough to make decisions or not. And then finally you have to communicate. So if you are making the financial analysis only for your own particular decision, you still need some kind of graph, chart, inside reports to be able to prepare for making those decisions. Or if you are doing it for somebody else, then you want to generate the results in terms of reports, in terms of graph, tables, or anything else. So AI can help you in all those five steps. I mean, not understanding the objective, because that has to be done by the person who is doing analysis. Data collection can be done, analysis can be done, validation has to be done by human. AI cannot do the validation that much, because the validation formulas are very complex. And communication, AI can support, can assist in preparing the reports, in preparing the analyzing report, preparing the charts, preparing the graph, preparing the tables. So those things can be automated. So let's move on and look at in these frameworks, understanding in more deeper details. The first step was to understand the need and objective of the analysis. So there are a few needs, like, for example, investment. So the investors may want to analyze the financial statements to make crucial investment decisions. And usually they are made based on the return on investment, the risk of an investment. So it can be measured using the profitability, using the liquidity, using the solvency, and the stability ratio. So we are going to learn more deeper details, but let's keep on rolling it so that we can complete the framework first, and then I will show you how we can analyze these parts in details. Then the second part is debt processing. So debt processing can be done via banks, via lenders, by any other person who is giving a debt to the company. It could be a financial institution who is giving a loan to a company. It could be a bank. It could be a NBFC, non-banking financial institutions. It could be a consortium of investments. It could be a mutual fund company who is giving a debt, or it could be any other entity who is giving money to the company for using. So usually, the objective of this analysis is to understand whether the borrower, the company, is creditworthy or not. You might have heard of credit ratings by Standard and Poor's, by Moody's, which are doing the creditworthiness of not only the companies but also the countries. So they have certain criteria, and this criteria is a mix of finance and non-finance indicators. How big is the balance sheet? How what is the quality of assets? How much liability they already have? How much productivity they how much profits they are generating, how much is their operating cash. So there is a combination of all of these factors plus their quality controls, whether the turnover is there, whether the health of the employees is good, whether the product is doing well, customer reviews are good. So the creditworthiness is evaluated using a combination of financial and non-financial indicators. Same like countries credit worthiness is not only measured by the GDP, by the GDP growth, but also the inflation, but also the human index, but also the transparency in the government policies, taxes, everything which impact the performance of the company or performance of the country to earn cash to be able to repay the debt and its principal on time, and with enough uh, uh, without any default, right? So that's the importance of the debt processing. So not only financial analysis, but there is another non-financial aspects which are at the play, right? Now there are some supplier and customer assessments. So suppliers and customers also, they don't assess directly the credit worthiness of the company, but they would like they most of many their big suppliers or the customers who depend for their supply chain on the subject company to a large extent, maybe let's say 50% or 60% or 70%. They would like to know the financial stability of their trading partner. So that is the important aspect for them to understand, right? So that they can ensure that the company will be able to meet their obligations. What if the you we have, let's say you are evaluating a vendor who is going to who is quoting for a supply chain contract of let's say capturing your 25% of your supply chain. If he is not creditworthiness, or there is a problem in his business model, or which sustain that it may go bankrupt in a year, why you would want to give them a contract even if how much cheaper or efficient they are compared to any other supplier, if there is no stability, right? Because you are going to disturb the entire supply chain after 1 year. So the companies want to understand the credit worthiness. So it's a bit tricky analysis. It depends on the company's needs. Again, there are some indicators by the company like their cash generating capabilities, their inventory turnover, their employees turnover, their the suppliers who have been working with them in the past, how was their experience. Not everything is financial, but and not everything is recorded, not everything is public as well. So it's a bit of tricky how the companies do that. Companies usually ask for financial statements, which are given to the assessor on a NDA, non-disclosure agreements, and it helps the assessor to establish whether the company will be able to sustain its growth or not, or at least a auditor report, because in a listed company or in a non-listed company, auditor's report gives a indication, if done right, that the company would be able to continue its business in the next foreseeable future or not. If there is nothing, then the auditors are bound to qualify that the company's business model is faulty, or they may not be sustained by in another 5 years or 6 years. So they are bound to disclaim that. But usually it doesn't happen in practical terms. Then there are management functions. A lot of financial analysis is done by the internal management, which is so it's not the last function and not the least for sure. It's quite robust, and a lot of time, majority of financial analysis is used by internal managers. So it's used by different level of management for different type of decision making. The senior managers or the board of directors like to evaluate the financial analysis to understand the overall performance of the company itself, the return, the share prices, the overall profit, revenue, growth, those kind of things where they can make the vision and mission related decisions, strategy decisions, right? But the line management or the middle management would like to analyze the financial statement to understand their own particular influence of area. See, the individual departments may not have a direct access or a direct uh, ability to influence the entire company, right? So they are more interested in their own departmental analysis, so where they can evaluate whether their own individual projects, individual departments are meeting the budget or the target set by the top management. So they have a different objective in their mind to analyze. Okay, this that was the first step. Second step is the collecting the data. Now collecting the data is, as I explained earlier, it's the data source for financial analysis. It could be internal data, where we are talking about the financial statements, sales reports, inventory records, segment analysis, expenses, and purchase reports, manpower reports, salary reports. There are tons of reports which a company is generating to understand a departmental performance. Now, does all of these reports are required for every kind of analysis? Not, certainly not. Right. For example, the inventory records may be suitable, may be required by by the person, by the customer who want to rely on this particular company for its supply chain. Supplier may not be interested in the inventory record. Maybe he want to understand if he's a big supplier, or you're buying bulk of his inventory, he may want to be interested to understand how fast you are selling, because that may help the supplier to establish whether the company will be able to sell quickly, and because that will determine their ability to pay back to the supplier as well, right? So the top management, senior management may not be interested in the inventory records, or payroll records, or even sales reports for that matter. They maybe are they're more interested in financial statements. uh, the banks, they may not be interested in sales reports and inventory reports. They may be more interested in financial statements, or customer or asset reports, or debtor report. So those are more important for them. So not everybody is interested in every kind of data. So you have to select what data we need for our internal purposes. Then there are external data sources. External data sources are the data which is market trend, competitor data, macroeconomic indicators. Market trends compare many of the industries like hospitality industry. There are research agencies who are issuing the specific data on the market, bookings, profitability, and geography, travelers, consumers, so that the decision makers can make their decisions. Competitor data usually are acquired by the survey. If it's not a public listed company, uh, it's not reliable. There is no reliable source except the listed companies or unlisted companies which are filing their reports to the government, and government is making a policy to public the data whoever request. So then this way you can get some credible data. Otherwise, competitive data in terms of financial statements is very hard to get for unlisted companies. You may be able to get the sales data or specific data which is shared by the competitors. Like for example, hospitality, we share occupancy data. I mean, but that is also not to everybody. It's a close group of competitors who are sharing the occupancy, revenue, rates data together with the internal competitors. Sometimes there are external parties who are collecting competitors' data and they are sharing the anonymized information on the ComSet. So they may say competitor one, two, three, four, but they may not identify who that is. Then there are some macroeconomic indicators like GDP, population growth, inflation, unemployment, or the other factors which may affect the company's financial position. Then there are and the depth of the data is required for different data is required. So for a management expert, detailed financial statement is needed, but a less detailed data or a condensed form is enough for shareholders to do a technical analysis. So it depends on how depth you would like the data to be. The data can be acquired in different depths. Then the third step is carrying out the analysis. So there are different tools that we discussed. We will discuss these tools together when we are going through the financial statements during the using a couple of scenarios. I will showcase some of these tools using in Excel and also using in AI. So there are some vertical and horizontal analysis. Vertical analysis basically is to compare a common size statement for profit and loss statements. Horizontal analysis compares the results over a period of time. Then there are trends, again, comparing over a period of time, looking at the growth rates. Then there are ratio analysis, right? And there are some other techniques like combining the two reports together and matching with the other indicators such as competitors data, such as looking at the sales report when we are looking at the inventory at the debtors report as well. So we have different ways of technique. I will show you some of them at the end of the class. So these tools serve different purposes. So we need to look at every different aspect we'll have. So I will show you some of the scenarios and tools which are commonly used. Then the fourth step was to validate the result. So we always compare the results against the output that we need, and did we get all the answers to potential questions or not? Right. That's the first thing you have to ask when you are validating the results. If yes, is there any new question raised during the analysis? So maybe there is the existing questions are all solved, but after you have done the analysis, there may be some questions left for explanation. So you may want to ask those questions. And usually when we start the analysis, we always have a hypothesis in our mind that okay, this for example, if I'm going to do the analysis of Apple, I want to probably buy Apple, right? And I may have made up my mind and say, okay, I'm going to buy Apple stocks, not Apple iPhone, Apple stocks. And I got the financial statements of Apple, look at last 4 or 5 years, and look at their macroeconomic growth, look at their demand factors, and I decide, and I want to convince myself that yes, Apple is a good stock. So I have a hypothesis that Apple is a good stock. Now, when I'm looking at the data, my hypothesis could be sustained and say, okay, yes, it's good or bad or ugly, or it could be completely different. And the analysis may come out to be, oh, it's not really what we thought. Apple is a bad stock to invest or maybe highly overpriced. So if you come up with a different answer, you may always have to look at the fundamental analysis again. The idea of comparing against the original hypothesis is to see whether do we are we making any mistake? Are we missing out any aspect in the result? And then we finally communicate the results, which is visualization techniques. So it could be graph, chart, or other visualizations, and sometimes tables and reports. So, reporting the data in a structured manner helps the company or stakeholders make understand the analysis in deep details, and also inspect whether there is the result, the analysis done in a complete manner or not. Okay, so let's look at the individual context, how we apply investments, loans, supplier assessment, and management functions. So let's start with the investment processing. So the state for investment processing, we need financial statements, industry reports, and market trends. Because the objective of the investment analysis is to evaluate whether we should invest in this company or we should not. So when we are looking at in this kind of objective, then only the financial statements will not be enough, and I will explain to you in a bit why these are not enough. And there are obviously definitely needed for the industry reports. The industry reports are necessary for understanding the overall industry situation, whether the industry is in declining phase or is in growth stage, compared to the industry, how the company that we want to invest in is functioning, whether it's a market leader or whether it's industry leader or whether it's a follower of the industry trends. And there are other industries. What are the demand factors in the industry? Whether the demand is supply, how is the demand supply gap? What are the market trends? Is the demand growing or shrinking? Supply is growing or shrinking? So there are multiple analysis that we have to do for the investment purposes. So for that, we usually calculate ratios, growth rates, and there are certain valuation models, discounted cash flow and comparables, which are available in the valuation reports. We may not go into details of valuation models, but we will look at the ratios and growth rates. And then usually our analysis also we have to benchmark against the company, against the industry benchmarks, or and we track the performance over a period of time. Now there is no point of analyzing the data of the company against their budget or targets. It does not make any sense, because that will not give a complete picture compare for investment purposes. It's good to understand the operational performance purposes, but not for investment. So we have to compare the benchmarks against the company's performance against their industry. When we are comparing against the industry, we have to be careful as well, and keep in mind that the different business models can cause different results to be coming out from the analytics. So you cannot compare direct Apple and Samsung directly, right? Apple is a different product, Samsung is a different product, even though both are working in similar range. They both have mobile phones, they both have laptops, they both have tablets, they both have other devices which they are selling. They both have cloud services, they both have everything. It's practically identical, but the class is different, and the products that Samsung is doing is different. Their business model is different, right? Apple is making mostly outsourcing their manufacturing, while Samsung is doing manufacturing for iPhone also, right? So there are different business models. So you can compare against Samsung, but you cannot rely on that comparison 100%, because results obviously are going to be different. So the best way is to track the over a period of time, because then you are comparing Apple against Apple, Apple against Samsung against Samsung in the previous years. How is their growth rate? And looking at the potential through the industry growth rates, rather than looking at the competitors. We will do that in a bit, for a while. Then the second step is the loan processing. Loan processing is again, we need financial statements, we need credit reports and loan application forms. And the the tools we use is ratios, cash flow management analysis, and credit risk assessment techniques. So, in the loan processing or in the debt processing, to be precise, the cash flow is one of the very important tools. Cash flow is also important in investment analysis for carrying out the valuation principles, valuation techniques, but not really. That's not the only basis of investment. So, but for loan processing, cash flow is the key. The ratios like inventory ratios, accounts payable ratios, debt ratios that we are going to deep understand in the next 1 hour in details. And there are benchmarking methods, right? Comparing these we can compare against industry benchmarks and then historical trend and repayment capacity. These are the benchmarks that we usually use for evaluating whether the company is worth giving the loan or not. The next category is supplier or credit assessment. Again, we need mostly the financial statements, but the non-financial document that we need for this purpose is the trade references and contracts. Uh, the tools we use is ratios, credit analysis, and industry analysis. The reputation analysis of the supplier as well. Benchmarking, we use the financial stability and reputation. Reputation is very important in credit assessment, in and supplier assessment, and monitoring the payment patterns and references. So, more than the financial ability, non-financial abilities are more important here. But financial abilities indicate quite a bit of important information about the company. Then, lastly, is management functions. So management functions, we normally need internal data more than financial statements because financial statements are usually combined and a very high overview of the company's performance. They may not be used for management purposes that much, except for the shareholders or the board of directors who are more interested in the share prices. But then the investment would the category would fall under investments, not under management functions. Management usually does the financial statement analysis to understand operational efficiency. So here we use budget analysis, variance, ratios, and trend analysis. And usually you compare and benchmark against the actual performance to the budgets, and or we may have set up some certain performance criterias or some progress criterias to evaluate the company's performance over a period of time. Right. So that's the benchmarking method that we use. Okay. So now let's the when we want to understand the investment by the individuals or financial institutions, we want to look at the financial statements analysis, right? That is a very important piece of information for any investor, whether it's an individual or a financial institution, because that gives a very precise view of what the company owns at the moment, who the company owe at the moment, and also what is their performance over a period of time in terms of income, cash generation, and their ability to pay or return the money in the future. So for that purpose, they look at financial statements is usually mainly two parts. One is the income statement that helps to assess profitability and operational efficiency, and the balance sheet. There is a third statement. We use it cash flow and notes to the accounts. But primarily, these two statements are quite important, right? And the ratio that we use most of the time is return on investment. So we use the formula called ROI, net profit divided by cost of investments. That is to understand whether and we use this ROI, return on investment formula, whatever we get from it, to compare against our desired ROI. So if the company's ROI resulting ROI is higher than our desired return of investments, we invest. If it's lower, we don't invest unless there is a clear proof that the company will be able to bounce back from the industry start back, or it's just starting now, and it will reach the level of investment that we want, level of return of investment we want in maybe a couple of years. So you may want to gamble on the future earning capacity of the company. That's what we call price to earning ratio. Price to earning ratio is the ratio of today price compare with the earning per share. So this is usually measured at the price that is being asked to pay today for the earnings that we you may get per share after investment in the future. So let's say if you want to hold 10 stock of Apple today, and Apple is and based on the history, if let's say Apple is going to pay you $3 per share, so and the market price of the Apple is, let's say, $200, so the return of investment in the PE ratio will be 200 over 3, 66 times, which is you can compare this with the industry and with the industry average, or even with the Sensex, the index of all the stock market, whether this ratio, PE ratio, is justified or not. But be aware, PE is not the only measure to make investment decisions. PE is just a suggestive that the price that you are paying today for the income that the company is generating, how many times is it? Now at the moment, mostly the 25 to 30 times of the earning per share is a good fair price for in the stock market. If you are getting anything lower than that, or the company is earning anything lower than that, that is not that is uh, uh, that is good, right? Because you're paying less price for a higher earning per share. If the PE ratio of any company is higher than 25 or 35, it means that it may not be good at this moment, but the majority of market wants to pay a higher price today because they want to get the shares at a because they are expecting the company to outperform in the near future. So that is why the PE ratios sometimes are skyrocketing for a new company. Let's say when the AI was launched, lot of the companies, Nvidia, chip makers, storage, cloud storage companies, their all share prices shoot up because people thought that AI will, since the AI is being launched, the demand for their product, it will multiply, and the earning capacity will multiply. So we should buy now so that we can get that higher income in the future. But that drive the price higher because the demand is going to be higher, 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 and then the price will be higher. So if you buy today, is all the future earnings for the next 2 3 years, 5 years has already been charged into the price. So it does not make sense to buy it at such a high price. So there are some tips. We You can use historical data for industry trends to benchmark the investment metrics, but it may not be sufficient. Industry data can tell you only a little bit about the company's ability to earn, but it may not be able to give you any idea about the future capability of the. And then you may not be considering the holding period, because or rely too much on the past performance. Even if the past performance has been super phenomenal, you still need to think about the future. Think about how long you want to keep the money, keep the investment. If it's like 1 year, 2 year, 10 years, or 15 years. If you want to hold the shares for 15 years, Even if the price is already very high compared to the next 1 year, 2 year, or 3 years earning per share, the PE ratio is factored only for next 2 years. But you are investing not for 2 years, you are investing for 15 years. Then you should still buy the stock. But if your investment holding horizon is only 6 months, then it may not be. Then you may need to look at the prices which are short term or distressed, right? Which are very low on the price earning ratio. And remember that not everything is recorded in the balance sheet or reflected in the financial statement. So what are those things? We will look at this after this analysis. Let me see if I have that already. Yes, here. So there are certain things which are not available in the financial statement. So which are those financial statements? So there are the company's financial statement does not record customer list which are generated by the company. They don't record the future earning capability, means the orders on hand is internal information, but it's not always available to the investor. So the future orders or the quotations or the leads, they are not recorded in the financial statements. The management talent, maybe the company has a superstar salesperson who is bringing all the business, who has been bringing, let's say, 80% of the business. So that value of that particular talent is not recorded in the balance sheet. So or in the financial statement. So if you are investing and you know that after investment the person will lose, you will lose the person. You may not want to invest into the company. So you have to be careful and looking at those things. Good industry relations, whether the company has industry relationships, being a part of the chamber of commerce or associations or groupings. If they have good relationship, it increase their ability to attract the talent and negotiate with the governments more favorably. The balance sheet also recognize only the fixed economic value of the fixed assets. So that is the important part that you have to keep in mind, that whenever we are preparing the balance sheet of the company, which we are going to look at it in few minutes from now, is recorded at the historical value. There is no the balance sheet does not describe the profit the buildings or the land values at the market price. Even though the accounting standards allow, not many companies follow this principle because it's expensive to do the valuations of the real estate. So not every company want to invest money into valuing the real value of the balance sheet, real value of the assets. But that's why they keep it at historical value. But when you look at the balance sheet, look at the profit and loss, you may not realize what is the real value of the fixed assets they hold. Similarly, the copyrights and brands, logos, which the company has not purchased from somebody else, but has developed over a long period of time, right? That kind of investment is not recorded in the balance sheet. It's recorded in the P&L in terms of expense. So, if let's say the company has spent a lot of money on brand marketing today, because of this marketing, in the next 1 year, they are going to have a very high sale. But by accounting policy, they have to charge all the expense into the profit and loss statement today. So this year, it will show a loss. Next year or next 1 year, 2 years, it will show a high profit, right? So if unluckily or incidentally, our analysis is based on that 1 year where they spend a lot of money on branding, on marketing, on developing the copyrights or patents, the money has been charged to expenses. So the ratios will be very bad. So you may be deciding to say, "Hmm, this company is not good," right? But in actual terms, the company is the gem. So this kind of information is not available on the face of the financial statements. You may have to dig it down into the different aspects of the financial statement. So that's how the financial statements work, which information is available and which information is not available. When we are looking at the ROI, our return on investment, or also called return on equity, in calculation, we usually use a very famous analytical framework we called DuPont analysis. DuPont was developed by a French company in the uh, early 1900s to understand their operational performance. By doing a DuPont analysis, and we divide the return on equity into three different parts because the company's ability to generate returns depends on various factors, and those factors are sales, how much sales we have generated, net income, how much income we have generated, and how much is the total owner's equity. So the net income depends on how much resources we have available. Resources depends on the capital that we have investment, and resources also depend on the total assets that we have. So the DuPont analysis basically wants to the idea here is to divide the company's performance into the company's ability to generate more assets from the limited money. So that is called the capital efficiency. From those assets or those resources, company need to generate a high turnover. Right? Means that is called the asset turnover ratio. How many times or how much turnover we are able to generate from the same amount of resources. Then from that particular resources, that particular turnover, how much the company is able to keep as a profit. That is called their operational efficiency. So the companies are that if the return on equity is good or bad, their analysis will depend on the three different factors, right? So that's how we look at it. Okay, let's now look at some examples. So I have prepared a sample file for you. So it's a data of the Walmart over a period of time. This is the data of Walmart, right? So this data is being is generated over the so this data has P and L, profit and loss statement, and balance sheet. Let me open a different file I think, for this purpose. Hmm. So this is more cleaner data. So this data is have the profit and loss statement from the listed from the public sources, and it has the balance sheet already available from the same sources. So we have the balance sheet and the profit and loss. Now, how do we do the the, the, the DuPont analysis, right? So DuPont analysis basically is the formula for DuPont analysis is DuPont analysis breaks down the 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 return on equity ratio to different purposes. So return on equity ratio is, or we call it ROE, return on equity, is calculated by net income divide by assets, divide by the total owner's equity, right? Which in our case, in our Walmart case, the net income, or you can say the net profits from the income is 11.6 million. Divide, let's say we can type it out, 11.6 million, and the owner's equity is 83, right? So how many percent we have it? You can say it's 13% for this year, right? We share it in this way so that I can copy it. Sorry, can copy this over a period of time to see the preference to see the growth on return on equity over a period of different time, right? Now the DuPont analysis says that wait a minute, the income depends on the sales. So how, what is the reason of it's going from 8 to 18 or going from 18 to 14 only, right? So we want to analyze and we want to understand, and maybe potentially we can compare against Target, another company, right? So let's work on this. Then the total, so the income depends on the sales. So the segment one for the DuPont analysis is called net income divided by sales. So net income is again we can take from the income, and the sales is coming from total sales, right? Which we can get from the profit and loss statement. Then we can calculate the percentage here. It's 1.9% or whatever it is, right? Sales depend. So there's another segment to it, segment two, which is says that sales depends on the resources that we have. Sales divided by assets. Sorry, assets divided by sales. So the assets are going to be total assets, total, or we can take net property, plant and equipments. We can take that one first instead of taking total asset, because total assets include all the cash and cash available. So the sales turnover ratio comes to 0.19. Then finally, the assets depends on how much capital we have invested. So the assets will be divided by the owner's equity. So out of 83 million in terms of owner's equity, we are able to generate 109 million worth of assets, right? So this is the segment 3. Now we can multiply all the segments into 1% into 0.19% and into 1.4. There's something wrong. I think it's the other way around. Okay, so we can multiply this and then we will get the formula, which is similar, which is same to what we calculated originally without any breakup, right? So that's the difference. Now you can see who what has impacted the company's ability to earn from 8% to 18% first. Let's look at these analysis first. So the company went from 8% to 18%, and the reason was the company was able to invest 79 million and it was able to earn 111 million of resources. So their ratio was 1.4, and from 2019 to 2020, the ratio went from 1.4 to 1.5, which is not a very significant amount of difference. The sales turnover, in fact, dropped from 4.6 to 4.1, which is 4 times. So not a significant improvement. But the 2019 to 2020 saw a very significant amount of improvement in the sales, right? So what it means that the company doubled the operating margin, so their equity return on investment, return on equity doubled, right? Also more than doubled. Now, from 2020 to the peak, it has now dropped to for 13.9%. So, what's the difference? The one difference is sales, the operating margin, which is coming down from 2.8% to 1.9%. So it means the operating performance of the company is getting low. Uh, the leverage is also getting low. Company has been not investing. The company's equity has increased, but the total number of assets had decreased. But since it's based on the historical numbers, there is a depreciation involved. There are other things which are reducing the value of assets every year. Uh, Plus, there are new investments as well. Company might have sold some of the property, plant, and equipments recently, right? So you have to understand the nitty-gritty details in more details. But the good news for the company is that their sales turnover means whatever resources they have, they are been using it to consistently increase their sales, which is the sales turnover is increasing significantly, right? So the good thing about the company is turnover is increasing. The bad thing about the company is, or not so bad thing about the company is that their assets to capital ratio is consistent, or you can say not too much fluctuating. But the bad news for the company is that their margins are shrinking again. So let's say if the company want to earn a target of 20% in terms of ROI, what it should do? It's not easy to, and the only leverage they can do is the sales, right, the margin ratio, right? So what they would be able to do? They because we know that the this ratio is a combination of these three factors. So what we can do is we can take a target of 20%, right, and divide this target from the multiplication of these two factors. So we will get a some amount, right? And that is we called our target margin. So if we want to achieve 20% growth next year, the company needs to achieve a profitability of 2.7% instead of 1.9%. Now company has been doing only 2.4 in the past 2 years. So this will set up a target for the management. If they want to earn 20%, this is the target they have to achieve. Now the income also is divided into multiple sources. Net income is a part of tax. Net income is a part of interest. Net income is a part of depreciation. Net income is a part of operating income. So we can further divide this ratio of 1.9% into the tax burden, into the company's interest burden, into the company's operating performance. So, and then we can establish whether the problem is in operating performance or company has been paying more taxes this year compared to any other year, right? So you can go into that detail, but for the purpose of this, maybe we can stop it here, right? Now, how we can use AI tools for this? So there are few methods that you can use. You can copy the data in Excel like this, simple, and then you can copy this data to Chat GPT. So if you don't have a paid version, your by default will be 3.5, which will be active for you. So you can use this as well. Sometimes GPT 3.5 will give a restriction on the number of characters that we can put in copy into this, but we can try it out again. So let's say we have copy paste the data here. Now we need to give it a prompt, right? Uh, Above is the data for Walmart. I would like you to carry out viewpoint analysis and give me your insights. Right. So it can calculate. Okay, it has calculated the Net profit margin 11 versus the our formula was a bit different, but it has calculated 16%, 16%, 15%, ROE 17%, and 10%. So it's a slightly different way of calculating, but is given. ROE has fluctuated, so it is giving us similar results that we arrived by ourselves, but it's much more faster, right? You can see it has just taken few seconds, and it has given a detailed answer to us. Now AI, you can use this, but the problem with the AI is that it's limited. So you can copy as much data as you can. There's with the free version. The another option for if you are a paid subscriber, you can go into the GPT-4 code interpreter, and then you can upload the file that we have used. So let's say we were using this file, you can upload this file, and you can tell it, okay, there are two sheets in the company in the sheet in the file containing P&L and balance sheet on each sheet for different companies, like a finance expert and carry out report analysis for both companies and give me your insights. So usually code interpreter should be able to understand the reports by looking at a description of the line and able to generate the formula for us. So let it do that for the time being. We can focus on our task while it's running. So that's the deep mode analysis. Okay. We will look at the key profitability ratios after the break. While we are working on it, okay, let's see. Working on. Okay, the AI has been not able to understand the file 100%, and it's always the different result that we get. Whether we are uh, how many times I give, it sometimes gives a different answer, but it can still generate. Mhm. It's not able to complete the details because it's not able to find the the assets and the equity, but that's okay, fine, we can leave that for now. But I show you the copy paste things work, right? You can just copy the data into it and then you can calculate it. We could simply go ahead and copy the target information in there. If it works, let's see if it works or not. It will allow. compare the companies and give your recommendations to their respective CEOs. So let's say you are a financial expert. You can easily compare Walmart and Target and then give your answer report. But of course, you have to read the report in details and give your recommendations accordingly. Don't just copy paste the analysis done by AI. Okay, let's take a break of a few minutes, let's say 5 minutes, and then we can come back with your question and answers on this so far. And then we will continue with our other profitability ratio and other aspects of the investment analysis.